Hi, welcome back to Father and Son Investing. We're going to wrap up our series today on asset location. We've learned during the past 3 videos that asset location entails placing which type of investments into which type of accounts. That's different than asset allocation, which is deciding how much of what type of asset you're going to hold, whether that be a common one can be 60% equities and 40% bonds. So asset location, we're going to wrap up this discussion today. The big take-home point out of this video that I want you to get is just how much you can save by putting your assets in the right type of investment accounts. I'll give you that number and we'll demonstrate that just how much you can actually save. We'll wrap up the discussion talking about which type of investors can benefit the most from using asset location, and we'll talk about what scenarios or circumstances you wouldn't want to be using asset location in. Let's get started. All right, just as a refresher, or for those of you who may not have seen the previous videos, let's just quickly cover where particular assets might do best in your accounts. We're talking about taxable investment accounts versus traditional IRA and 401k and Roth IRA. So generally we want to put the most tax efficient investments into a taxable account, the least tax efficient investments into IRAs, 401ks, or Roth IRAs. So municipal bonds, obviously, those are pretty darn tax efficient. Those are going to go in your taxable account, and I'll let you look at the list here. When it comes to U.S. government treasuries, those really are kind of in between, and depending on your circumstances, you may want to hold those in your taxable account, or you may want to hold those in your traditional IRA or 401k or even your Roth IRA. If you'd like to see more discussion on this part of the topic, I would encourage you to go back and watch the 3 previous videos in this series. This is from Evan Leventhal, who left a comment recently on my video about not putting certain types of investments in your IRA, or which type of investments to put in your IRA or 401k. He went on to say that he usually likes my videos, but thought that I flubbed my analysis on one part of the video. And in there, he reminded me about marginal tax rates and the pre-tax accounts. He made a very good point. I'd encourage you to read his comment, but he also brought out that I didn't pull up the net investor income tax of 3.8% on high earners. If you're not familiar with that, that is part of the Affordable Care Act back in 2010, otherwise known as Obamacare. Essentially, that places a tax on investors, or even if you're not an investor, even if you just have a savings account, if you're making more than a certain amount on your modified adjusted gross income, otherwise known as your MAGI, you will be subject to this additional tax. So just for Evan Leventhal, I want to show that this also includes that tax. So this comes from a paper written by Vanguard called Conventional Wisdom Regarding Asset Location. And in here they run multiple different scenarios trying to figure out whether using asset location really actually saves you any money on your taxes. So I've got this nice chart here that actually gives you the basis points that you could expect to save. Remember, a basis point is 0.01%. So when this says 16 basis points, you could expect to save 0.16% on your taxes. I know that might not sound like much, but wait till I show you in a scenario just how much money that actually adds up to when you look at it over 20 or 30 years. So in here they show the tax brackets, and where it says preferred, that's really looking at your long-term capital gains rate. Now you may see 24% and say there is no 24% long-term capital gains rate. This actually adds the 20% long-term capital gains rate and the 3.8% tax that I just discussed regarding Medicare. So that adds up to essentially 24%. You can see here then that if you are in the 37% tax bracket, just as an example, and you have a very aggressive strategy, you could expect to save 8 basis points here in their model. Versus if you're very conservative, that means having a lot more bonds, essentially, you could expect to save 16 basis points. However, if you look at these in different categories, you'll notice that these basis point numbers start to go up. And if you're going to be bequeath your investments after you die to someone, you can see that with that step up that can happen with a taxable account, the step up in basis, if you're not familiar with that, instead of your heir getting charged on your original basis on what you purchased the stock for, when you pass away, your heir essentially gets to step up to a new basis at the current value of the stock. So if you're calculating in a step up in basis, you can see that that can go as high here as 32 basis points in this example. Now they go ahead and run multiple different types of scenarios depending on which priority you are giving to your accounts. You'll notice here that this says TRX. T is traditional, R is Roth, and X is a taxable account. So this would be giving first priority to your traditional IRA or 401k, then your Roth, then your taxable account. In the previous scenario that I showed you, that also was TRX. However, in this paper, they do also go on to run it as XTR, and you can see the basis points here. I'm not going to belabor this. You can go into this paper. I will leave a link for you. Here's the take-home message I want you to get from this video. You can expect to save about 25 basis points per year using the tax location strategy. If you had $1 million, you could expect to save $2,500 the first year. That might not seem like much to you, but over a long period of time, that can really start to add up. So just how much money could this save you? We're going to use a paper here from Morningstar called A Guide to Tax Managed Investing. In their scenario, they're going to take $100,000 as a starting point, and they're going to prioritize this by tax growth prioritized, meaning your taxable account, versus tax deferred growth prioritized, meaning prioritizing your 401k or IRA. They're going to use 20 years with 8% average annual return on the equities and 4% average annual return on the bonds. After 20 years, the after-tax value of the tax growth prioritized account, your taxable investment account, is $917,000. After 20 years, the after-tax value of the tax-deferred growth, meaning your IRA or 401k prioritized, is $870,000, a difference of a little more than $47,000. Now that might not seem like much, it seems like a lot to me, but let's just increase the magnitude here. Say you start with an initial investment of $500,000. Well, you could go ahead and multiply that $47,000 by 5, and you're looking at $235,000 difference after 20 years. Now that would be money that would otherwise go to the government that you get to keep for yourself and your own enjoyment, or bequeathing to your heirs, or providing charitable contributions. I'll tell you that there's a nice paper here called the Kitces Report that I will also leave a link to. I won't show you all of the data here. It's about a 12-page report, but this goes into very good detail just how much money you could expect to be saving, and also concurs that about 0.25% or 25 basis points is what you would be looking at. Let's turn our attention now to who can benefit from using the tax asset location strategy. There generally is some consensus here, although you may find a little bit of some varying opinion. But essentially, you could look at if you are currently paying a high marginal tax rate, you are someone who may benefit from this. If you expect to pay lower income taxes in the future, i.e. when you're retired, you are someone who could benefit from this strategy. If you have significant tax assets in taxable inefficient investments held in taxable accounts, you are someone who can benefit from this strategy. We covered this in previous videos, but you could think about real estate investment trusts here. You could think about actively managed funds who are trading a lot and therefore making a lot of capital gains. And then lastly, if you're investing for the long term, this could be a good strategy for you. Now, when might this strategy not be good for you? We're going to borrow from the folks here at Above the Canopy. They give a scenario here talking about if you're using a 529 savings account, you might not want to include this in your tax location strategy. Putting a bunch of risky stocks in there that suddenly lose value right when you're ready to pay for tuition means that you might have to sell off other assets in order to pay for tuition. Likewise, if you're saving for a short-term goal, this would not be part of what you would want to include in your overall asset location strategy. Short-term goal money really should be kept in investments that are more safe, particularly things like U.S. Treasuries or a high-yield savings account or a CD. Now, before we finish here, I would like to encourage you all to be like Evan Leventhal, and if you disagree with my reasoning or you think I could have done something better, please leave me a comment and indicate where I went wrong. I call it the Clark Stinks moment. I have listened to a lot of Clark Howard podcasts over the years, and he does a certain segment where listeners tell him where he stinks. Feel free to let me know that I stink like a fill in the blank. If this was useful information for you, please give us a thumbs up. And until next time, enjoy your investing.